This year has been all about growth, but 2021 belongs to the dividend investor. The market is coming around to these dividend stock sectors, and I found 5 stocks with double-digit return potential on top of the highest dividend yields in the market. In this video, I'll show you how to find the best dividend stocks to buy and then reveal the 5 I'm watching. We're talking dividend investing for 2021 today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click the little red subscribe button. It's free and you'll never miss an episode. Nation, if the 2020 market crash has taught us anything, it's that nothing beats dividend cash flow. That cash in your pocket is always going to be a positive return, no matter what happens to the share price. That's why for our 2021 investing series, I wanted to highlight 5 dividend stocks to buy as part of that portfolio for maximum returns next year. Over the next week, I'll also be adding to the series a list of best stocks for returns and penny stocks for those moonshot investments. I'll be putting each of these videos inside our playlist on the channel, the best stocks to buy for 2021, so make sure you check that out for the entire portfolio. In this video, I'll share what I'm looking for in 2021 dividend stocks, the sectors to find the best returns and cash yield. I'll then reveal those 5 top dividend stocks to buy right now. In fact, I'm also reaching out to some friends here on YouTube to get their input and their dividend ideas to put on our list, so be watching for those from some of your favorite investing channels. But I also want to get your opinion on this. Which are you focusing on, those dividends or growth stocks for your 2021 portfolio? Do you think those dividend stocks are going to do better, or those growth stocks that have done so well this year? So just scroll down and let us know in the comments, which do you think will do better in 2021? Overall though, I think it could be a very good year for dividend stocks. This graphic reveals some excellent research by FactSet, one of my favorite researchers on the sector returns estimated by analysts over the next year. Now this is how much higher analysts see target prices for stocks in each of those sectors, with an overall return of 11.6% expected on the S&P 500. And now while everything seems to be dwarfed by that expected 46% return on energy stocks, there are also some solid returns expected in healthcare and financials, as well as some of these other sectors. And fortunately for the dividend investor, these sectors with the highest expected returns are also coincidentally the ones where you're going to find the highest dividend yields, and that's where we're going to be looking for our stocks to buy, in the energy, healthcare, financials, and real estate sectors. And our first 2 dividend stocks here are going to be in a classic cash flow investment, real estate investment trust. The table here by the National Association of REITs shows that property has been hit hard this year with a 15% loss overall, and as high as 40 or 50% in some property types. Still though, you know I'm a big believer in real estate. It's where I started my professional career at, and no other asset has created as much long-term wealth as this property sector. And it overall pays a 3.9% yield, which is more than twice the 1.7% yield on the broader market. In our list, I want to focus on some of those rebound plays like retails and malls, banking on those higher yields, but also looking for stocks with that strong upside price appreciation. Our first dividend stock for 2021 is a favorite of mine, Medical Properties Trust, ticker MPW, for a 5.5% dividend and a long-term cash flow machine. MPW owns more than 390 hospitals, long-term care facilities, and other medical assets in 9 countries. At $17 billion in assets, this is the second largest owner of hospital beds in the United States. It books 67% of its revenue from the States, 26% from Europe, and another 5% from Australia. And this is a very well-diversified portfolio of assets, maybe a little heavy in that general acute care with 80% of assets, but very little in that senior care facilities that have hurt those medical REITs over the past year. And what I really like about this stock is the business model for the company. It uses a sale-leaseback strategy for its acquisitions, which just means it buys medical properties from the healthcare companies and then leases the property back to them. So servicers like this because it frees them up to do what they do best, to focus on that healthcare, and then MPW can focus on what it does best, manage the real estate. So this is just decades of potential growth as the company takes advantage of the ultra low interest rates right now to consolidate all those medical properties out there with gross assets growing at 30% annualized pace over the last 10 years. Now the company puts these leases on a triple net model, which means the tenant bears all the property costs. These are long-term leases, up to 20 years or more, and 97% of them have that inflation-based rent escalators each and every year. So basically, with interest rates as low as they are, the company can borrow at next to nothing, buy a property and immediately lease it to its tenant for 20 years with no property related expenses. It's just swimming in that free cash flow. Now, of course, this year, and the reason why shares are down 18% from their peak, is the pandemic has forced healthcare facilities to really cancel all those non-critical services. That means all the cosmetic surgeries, all the electives that are those higher profit margin services, and the hospitals are just losing it. Now, this doesn't affect MPW quite as much because of how those leases are set up, but anything affecting the tenants is going to hit the landlord as well. The upside here, though, is that as we do get back to some version of normal and those elective procedures get scheduled, hospitals could be flush with cash, and that uncertainty is going to come out of the shares in MPW. Medical Properties Trust announced its 8th consecutive year of higher dividends. The annual dividend of $580 million is just 80% of the funds from operations here, and we've already seen how this cash flow is just super stable. The balance sheet is also fairly clean here, with no debt maturities next year, and total debt is spread out, other than about $3 billion to refinance in 2024 and 2025. Now, on this, I would expect management to take advantage of those lower rates right now and refinance a lot of this debt out into the future, which could free up a lot of cash flow. On the valuation side, at a price of 14.5 times on that FFO multiple, it comes in just under the 18 times multiple, which is the average for the REIT sector, though it's right around the average for medical properties. Analysts have an average target here of $21.29 per share over the next year, but I think it can go back to that high, around $24 each, for a 20% return plus that dividend yield. This next dividend stock is in one of the hardest hit industries and potentially the highest upside though. Mall operator Macerich, ticker MAC, and its 5.5% yield. Macerich owns 29 Class A regional malls along with another 19 malls as part of a partnership and 12 non-mall properties. That is a total of over 50 million leasable square feet and averages $800 in sales per square foot, which is well above the average for mall properties and really speaks to the quality of assets in this portfolio. The company sold off over $4 billion in its lower quality malls over the last 8 years, so it really went into this thing already positioned for that quality. Now, sales per square foot were only down 10% in the third quarter, and occupancy held at 91%, which is really amazing considering the retail apocalypse that we've seen. Now, the fact that the shares jumped 34% on that news of the third quarter report, that tells you something about the direction of the financials are going, and this stock is still 60% off its 52-week price. And now here, I know a lot of you are going to be comparing Macerich with its larger competitor, Simon Property Group. That's ticker SPG, one of the biggest mall operators in the world. Now, Simon Property is about 16 times larger, offers a 6% yield, and the shares are still off the high by 41%, so why not go for that one instead? The idea here is that Macerich owns those higher quality mall assets. That's undeniable, and I think it shields it from the longer term weakness in mall retail property. More than that though, I like Macerich here over SPG because it doesn't seem to be getting mixed up in the retail business like Simon Property Group is doing, which is bidding on a lot of these bankrupt stores like JCPenney's. Now, instead, Macerich is focusing on staying that landlord, staying within its business model, and just finding new tenants like Amazon and other distribution. Macerich did slash its dividend this year, but before that, had a strong record back to 1994 for payments. It has since then increased the dividend back up to 15 cents a share, and I expect further increases to be job one for management. Now, even at that lower payment, which is still a respectable 5.5% yield, Macerich is only paying out 25% of its funds from operations to cover the dividend. As we get closer to a vaccine and get people vaccinated probably into the summer of 2021, I think that per share dividend could easily double or more. Now, with any of these rebound stocks, especially the mall operators here, you want to be looking at that balance sheet to make sure that the company has enough cash to pull through this thing. Macerich has increased its cash to $530 million on the balance sheet, which is enough to cover 19 months of its total operating expenses. So plenty of cash here and more than enough liquidity if it needs to borrow against those high quality properties. Now, funds from operations this year are expected 34% lower to $354 million, so even after that big jump in the shares recently, the stock is still trading at 4.6 times FFO. I'm not saying this one gets back to $27 a share anytime soon, but I think you get a nice double-digit return over the next year, plus a per-share dividend that could double from here. These next two stocks include one with a 27% upside potential to the average analyst price target and 5% dividend yields. But first, I wanted to personally invite you to our private Facebook group, Let's Talk Money Together. I love the back and forth conversation we get going on in this group, much more like a community than we get here on YouTube. I'll leave a link in the video description below, or just look on Facebook for the Let's Talk Money Together group. Our next stock here is going to be from the financial sector, and one thing that you've got to understand here is the difference between capital market and commercial banks, and what could be one of the biggest catalysts for the returns this year. So on the one hand, you've got capital market banks like JP Morgan and Goldman Sachs with lots of exposure to those stock trading fees, the IPOs, and really everything to do with the financial markets. With the stock market soaring this year, those types of banks have done better. Goldman is even positive on the year. Now you compare that against the returns for the lending banks like Wells Fargo and Huntington, seen in purple and red here in the chart. And besides just the lower interest rates that have hit profitability, the pain has really been in the tens of billions these commercial banks have had to move from their income statement to what's called a loan loss provisions account. Now, loan loss provisions are just a safety net that the banks make when the economy looks weak. Basically, the bank tries to estimate how bad the economy could get and how many of those loans could go into default. It then sets aside a certain amount of money as cash, as a cash cushion, just in case those loan defaults do start to increase. The way it does this is the bank is going to take that money out of its earnings, out of the income statement, and put it into a separate account on the balance sheet. This is the loan loss provisions account. That's what we saw in the first 2 quarters of the year for these bank stocks. They still did relatively well on that revenue side. They made the loans and they had the money coming in, but they were taking so much money off of the income statement, off of those earnings to put in these safety nets accounts, these loan loss provision accounts, that there's just nothing left when you get down to the earnings. Of the 4 largest banks, the Wells Fargo, Bank of America, Citigroup, and JP Morgan, they've exploded that loan loss provisions to $24.6 billion, up almost 400% from just $5.2 billion in the last quarter of 2019. Just these 4 banks are sitting on $24 billion in cash in that what-if account. But now where I see that catalyst for massive returns in the financial sector is that if we do see a recovery in the economy, there just isn't going to be that kind of loan defaults that these banks are estimating. When that happens, you're going to see these tens of billions of dollars come back onto the income statement from the balance sheet. So they're going to move those loan loss provisions back onto the earnings for an earnings explosion. And that's why I think you've got to add bank stocks to your portfolio right now. Within the financials, one of my favorites is Huntington Bancshares, ticker HBAN, and its 4.9% dividend yield. Huntington has over 800 branches across 7 Midwestern states and 150 years in operation. Importantly, for any regional bank, it's been evolving into the digital environment with over 100 online products launched in the last 2 years, including money management and savings automation. Active mobile users are increasing at a 10% annual pace, with the branch network shrinking about 4% a year, so it's making that digital transformation and cutting costs where it can. Revenue was up 5% in the 3rd quarter, and loan growth is expected 6% higher this year, but earnings are down 20%, and that's where we see that loan loss provisions theme. The bank has added another $1 billion to its loan loss provisions account from $800 million just last year. So again, what we're looking at is if we do get any kind of a stimulus package or an economic recovery or both, I think loan losses come in way lower than expected, and the bank can move a lot of that loan loss account money back into the earnings, back into the income statement, which could be a big surprise to the upside next year. Now, that's just one of the upside catalysts for bank stocks in 2021. Another one would be increasing interest rates and that net interest margin. Now, I don't want to get into a detailed review of how banks make money, but one of the biggest hurdles over the past year, really, and this year especially, is the long-term rates. The rates that banks collect on those loans have shrunk to just almost nothing. Huntington is making just under 3%. That's the difference between the rate on the long-term loans that it collects and the rate that it pays on deposits. With loan growth of 6% and deposits growing 10%, it was still able to turn that 3% interest spread into positive profitability. But if that spread widens to maybe a 3.3% where it was just last year, that could mean tens of millions of dollars in additional profits. The bank didn't increase the dividend this year, as it usually does, but it didn't cut it either, which is really saying something, considering that the Fed pretty much forced a lot of the commercial banks like Wells Fargo to cut its payouts. Huntington right now is paying out 85% of its net income to cover its dividend, which is fairly high, but earnings are expected 53% higher over the next four quarters. That's to $1.09 per share, and that would lower the payout ratio to just 55% and could mean dividend increases to come. Shares trade for a price-to-book value of just 1.13 times, which is a 21% discount from last year's multiple. I think you get a solid double-digit return here, plus that dividend yield of about 5%. And the next sector I wanted to include here in our dividend portfolio is utilities. And this isn't so much for a valuation perspective as just that stability and the cash flow that you get with the sector. But now the stock I'm adding offers not only one of the highest dividends in the list, but also the highest price upside as well. First Energy, ticker FE, and its 5.5% yield. The company is a fully regulated utility with 6 million customers across 6 mid-Atlantic states and over 24,000 miles of transmission lines. Management is forecasting 10% annual transmission rate growth through 2023 and 4% annual growth for distribution. This is one of the most stable cash flows in utility stocks, and the shares would be higher, except for one little legal problem lately. The company terminated its CEO in October and saw its bonds downgraded on governance concerns that have hit the shares. The Department of Justice has implicated First Energy as the source of about $15 million in funds used by a former Ohio House Speaker in a bribery case that would benefit 2 of its nuclear plants. The investigation is ongoing, but I think the worst is really baked into the stock here. That outcome, good or bad, shouldn't materially affect the company's bottom line, and the headline risk has really created a super cheap stock. First Energy is expected to report $2.59 in per share earnings over the next 4 quarters, just slightly below the $2.62 it reported over the last year. That would put the share price at just 11.2 times earnings, one of the cheapest in this sector. The dividend payout was held steady this year to protect that cash flow and represents just 60% of earnings, so I don't think an increase is far off here. The average analyst price target of almost $37 a share here is more than 27% higher than the current stock price, giving First Energy the highest upside in our list. One more stock left on our list, and it offers the highest dividend yield yet, almost twice the payout that we've seen on these others. But make sure you catch those other videos in our 2021 playlist. We started last month with a complete investing strategy, and I'll be adding these new videos next week. Energy stocks have been on a tear lately with our 2 portfolio picks, Diamondback and Devon Energy, up 41 and 56% just in the last 2 months alone. But we could easily see another double-digit return for these stocks in this sector, on top of that highest dividend yield in the market. Now, before you get too excited about that 17% dividend you see here on the shares of Energy Transfer, that's ticker ET, the payout was recently cut. But even after that, it still pays out a 9.1% dividend yield and should be safe from here. ET is the leader in midstream with 9,300 miles of crude pipeline, making it the largest in the US, and assets across that transportation, processing, and storage space. Beyond its size, what makes Energy Transfer unique is just it's a fully integrated model with pipelines in every oil play in the country, the ability to fractionate gas into NGLs, and the terminals to export that oil and the natural gas liquids. MLPs, those master limited partnerships that own these pipelines, have been hit just as hard as the rest of the energy space since 2014, but there are some strong reasons to buy in here. Now, Energy Transfer was investing over $8 billion a year in acquisitions and development from 2015 through 2018. Assets were cheap, and after the 2014 crash, management made some very smart moves. Now, a lot of those big development projects are coming online and starting to gush cash flow. Combine that with the fact that management is planning on cutting its investment spending in half to just $4 billion a year, and that cash flow could surge even further. Energy Transfer has a coverage ratio of 2 times the distribution in its most recent quarter, and this is a very important measure for those MLPs, those master limited partnerships, so I want to explain it a little bit more. That coverage ratio here is the company's distributable cash flow. That's the cash it has left after that maintenance spending, everything it needs to spend to keep the company running, over the amount distributed to shareholders. Now, some MLPs will have a coverage ratio of less than 1, meaning that they're paying out more than is available, something that obviously can't go on forever. So for Energy Transfer to be able to cover its distributions, a yield that's almost 10% right now, to be able to cover that by almost 2 times means cash flow is all but guaranteed. Better, though, is that management expects the coverage ratio to come down to around 1.8 times longer term, which to me hints that they expect to increase the dividend. Cash flow isn't decreasing with all these new projects and these lower investment spending, so there's only a couple of other things they can do with that money. ET is either here going to be buying back shares, massive amounts of its own stock, or hiking that dividend, or both, and that's going to send the shares higher. Click on the video to the right for our 2021 investing strategy, how I'm positioning and in which sectors for those maximum returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.